Hi everyone, welcome back to our channel. Today we are going to talk about an interesting topic, which is how to split the spread and capturing better prices when doing trades, especially on options. So this is an interesting topic because most investors, when they start, especially trading options, they don't know exactly how to determine the price, and usually this is a moment when the traders lose money, and usually they buy for higher than they should, or they sell for less than they should for each of the contracts that they are trading. So it's important to have some information about splitting the spread and do this carefully. Essentially, traders are constantly seeking strategies that improve execution quality, reduce costs, and enhance profitability. And splitting the spread orders is one of the options that they have to reduce the costs of trading. These orders can provide significant price improvement when executed and may even qualify for exchange rebates because they are adding liquidity to the market. So what this means is that sometimes when you use a specific type of order which helps the market to deliver better results, then the exchange may pay you rebates. Usually this doesn't happen with small traders because the volume is very small, but as you have more trades and you have trades with high volume, then you can get an agreement with your exchange or with the company that you're trading with, and they are gonna pay some rebates for you to trade. And in fact, this is one of the secrets of bigger traders, is that they usually make money by trading more and receiving these exchange rebates. So let's talk about understanding split spread orders. So a split spread is essentially a limit order. In other words, an order where you say specifically the price when the trading is going to take place. And it is priced between the current bid and the ask. Okay, so this is important because if you don't use a limit order and instead you use a market order, what happens is that you're going to be served at the bid or the ask, depending on the kind of order to buy or sell that you are placing. But if you use limit orders and you split the spread, then you have a much better chance of getting a good price. In other words, you're not depending on this automatic pricing that is given by the exchanges. So this is one of the advantages of trading in options, is that you can try to get a better deal for your trades, and usually that is possible. Unlike traditional limit orders placed at the best bid or ask, the split spread orders will attempt to secure a better price by narrowing the spread. So many people, especially when they begin trading, they have this impression that you're required to place your orders either at the bid or ask, but that's not the case. Okay, so here's an example. Suppose that a stock has a bid of 50 and an ask of 50.10. Okay, so the example is, instead of placing a buy order at 50 or 50.10, what you can do is to place a buy order instead at 50.07, okay, or placing a sell order at 50.03. So in that case, you are trying to get 3 cents more for the either the sell order or the buy order. In other words, you are gonna try to sell for a little more or buying for a little less. And this is a big advantage, especially if you are trading a lot of contracts. If these orders execute, then the trader benefits from price improvement. In other words, buying at a lower price and selling at higher price than the prevailing market. Let's talk about the benefits of split spread orders. First is price improvement. In other words, you're gonna either pay slightly less than the value that is currently displayed in the market. We can also have, as I mentioned, potential exchange rebates. Many exchanges offer liquidity rebates to traders who provide liquidity. In other words, they post resting orders instead of taking liquidity, which is to execute market orders. Since split spread orders are limit orders that sit on the order book, they may qualify for these rebates, further reducing trading costs. Okay, so yeah, that's the reality is that this only happens when you have a certain volume of trading, and because they are not gonna pay rebates for trading just one or two contracts. But as you trade more, this is a very important feature. Also, reduce the market impact. Aggressive orders that take liquidity, which is the case of market order, can move prices unfavorably, especially in large quantities. Split spread orders by contracts passively wait for execution, minimizing market impact and slippage. So to understand this a little better, the issue here is that when you do a market order, you are trying to move your order immediately, and whenever this happens, there is an impact in the market because you are basically increasing the speed of the current move. So, for example, if the market is going down and you are selling at that exact moment, then what we are doing is to increase this movement to the downside. Okay. However, split spread and limit orders in general, they are different because they are only executed when that particular condition happens. Okay, in other words, the price reach this particular level, and in that case, you are not moving the market in that direction. You are basically doing exactly the opposite. The market is moving to you, and this is something that the stock market likes. So instead of putting more pressure on the current direction, you are taking pressure. So that's why you have benefits. So when to use split spread orders? So there are some situations where this is good. Liquid markets with tight bid-ask spreads, high frequency trading and algorithm strategy where small prices advantages matter. So this is, as I told you, if you trade a lot, then this is even better strategy. And low volatility conditions where spreads are stable and orders are more likely to fill. So even though this works for high frequency, this doesn't mean that you as a small investor shouldn't be doing this. In fact, I do this all the time. I look where the bid ask is, and then I always move my limit orders close to the middle of that range. In this way, you always get the benefit. The only disadvantage of doing this is that there is execution risk. In other words, there is the risk that your orders will not be filled at that particular price. So this is something that you do when you have when you are not rushed in the particular trade you want to do. Okay, if you really, for example, want to execute the trade before the end of the session, which is going to be maybe in a few minutes, then that's not a good strategy. You have to do that as quickly as possible. But if you have time, if you can do this in the next hour or even in the next few days, why not? Just use the spread trade strategy. Another problem is opportunity cost. You may not be waiting because waiting for a better price could mean missing the trade entirely. So there are some situations where you want to really make a trade exactly at the moment that you want, and in that case, it's better just to go to the bid ask standard price. So basically, these split spread orders are a powerful tool for traders, and you should use them as when you have the opportunity and whenever you want to have a better price. That's the moment when you should use this kind of strategies. So this is the information that I had for you. If you want to read this information for yourself, I will put a link down in the comments, and you can visit our website Trading Daily Alert. So that's what I had for today. Thank you very much for watching our channel, and see you next.